A new street high, by the way, to $360 from $315. That's near 30%.
And when
upside.
I first saw that, I was really wary of it. And then I actually went and read their notes on it. And they said they think that they're getting to $20 of earnings in 2024. If they do, then it's only trading at 14 times right now with significant earnings growth ahead. So it's actually reasonable. But I think what slows down the big seven, what slows down tech, is just prudent portfolio management and rebalancing.
Yeah, Scott, there's a lot of confusion about buying short-term treasuries and why there's value in it. We don't see value in 6-month treasuries, even though it's the highest part of the yield curve. We're buying
more than 5%, right?
Right. We're buying long-term munis now, figure 4% tax-free yield, because if the economy slows or if the market goes down, those bonds are going to go up in value. Not to mention, guy sells his business, gets 25, 50, 100 million bucks. He doesn't want a lot of risk in the market. He wants that cash flow tax-free from a safe bond portfolio that benefits from a slowing economy.
Yeah, he took the risk off. That's why he sold the business.
Exactly. So that's really where we're at on that.
That's right.
You want to comment on this Alphabet call that we have today? A couple of downgrade yesterday at UBS, a downgrade today at Bernstein. What do you think about the valuations in general of large cap tech?
Well, me?
Yeah.
They're high.
Well, because you own Alphabet. That's why I'm asking you specifically.
They're high.
About that
we know they're high. There's no, even the most bullish tech investors right now will tell you that these stocks are selling at premium multiples, both to their own historical multiple and, of course, to the overall market. That's not, I don't think that part of it is in contention. And oftentimes what you'll see is analysts will look at a story where the stock has gotten ahead of what they think the actual fundamental change is, and they'll do the prudent thing. They'll say, hey, if you've been riding the stock, maybe right now might be a good time to take a little bit off. I actually think that that's smart. I took some of NVIDIA off. A lot of the run in Alphabet has been predicated on revenue and earnings that may at some point come as a result of all of their AI initiatives. And Google has been working on AI seriously since like 2014 when they bought DeepMind. So it's a very long time horizon for AI to truly become a fundamental driver when you look at a cash flow statement. It's a fundamental driver of stock price today. So that part might have gotten a little ahead of ourselves. If you look at 20-year historical average for technology companies, even though I know some of these are now considered communication, but bear with me, 18 times. We're at 27. So we know they're premium. We know they're up a lot. We know a lot of the reason they're up is sentiment and excitement. And this might be a good time to take your tech exposure down.